Hey everyone, welcome back to our YouTube channel AQIB TJ. Today we are diving into a hot topic: what is a recession? Causes, impact and how economies recover. Part 1. Subscribe for the next part. What if I told you that an economy can suddenly slow down, jobs can disappear, businesses can shut down, and markets can crash, all at the same time? That's not just a bad year, that's a recession. But here's the real question: why do recessions happen? And more importantly, how do countries actually recover from them? In today's video, we're breaking it all down, clearly, simply, and in detail. What is a recession? A recession is a period of significant economic decline that lasts for months or even years. In simple terms, it's when a country's economy starts shrinking instead of growing. Technically, economists often define a recession as 2 consecutive quarters of negative GDP growth. But it's more than just numbers. During a recession, businesses earn less money. People lose jobs. Consumers spend less. Investments drop. Overall confidence in the economy declines. It creates a chain reaction across the entire system. Key signs of a recession. Before a recession fully hits, there are warning signs. Here are the most important ones. 1. Falling GDP. When economic output declines, it signals that businesses are producing and selling less. 2. Rising unemployment. Companies cut costs by laying off workers. 3. Decreased consumer spending. People spend less due to fear of losing income. 4. Stock market decline. Investors lose confidence and pull money out. 5. Lower industrial production. Factories slow down or stop production. These signals often appear months before a recession becomes official. Why do recessions happen? Recessions don't just happen randomly. They are usually caused by a combination of economic factors. Let's break them down. 1. High inflation. When prices rise too quickly, people can't afford goods and services. As a result, spending drops. Businesses earn less. Economic activity slows. 2. High interest rates. To control inflation, central banks increase interest rates. But higher rates make loans expensive, mortgages harder to afford, businesses less likely to invest. This slows down the economy. 3. Asset bubbles. Sometimes markets grow too fast, like housing or stocks. When prices rise beyond real value, a bubble forms. Eventually, the bubble bursts. And when it does, investors lose money. Banks face losses. The economy contracts. 4. Financial crises. Problems in the banking system can trigger a recession. If banks stop lending, businesses can't grow. Consumers can't borrow. Economic activity collapses. 5. Global events. Events like wars, pandemics, supply chain disruptions can severely impact economies. They increase costs, reduce trade, and create uncertainty. 6. Decline in business confidence. If companies expect tough times ahead, they stop hiring, reduce investment, cut spending. This behavior itself can push the economy into recession. Impact of a recession. Recessions affect everyone, directly or indirectly. Here's how. Job losses. Millions can lose their jobs, increasing unemployment rates. Business closures. Small businesses struggle to survive due to lower demand. Falling incomes. Even those who remain employed may face salary cuts. Reduced investment. Investors become cautious and avoid risk. Government pressure. Governments face lower tax revenue but higher spending needs. This creates a difficult situation for both individuals and policymakers. 5. How do countries recover? Now comes the most important part: How does an economy recover from a recession? There are several key strategies. 1. Monetary policy, central banks. Central banks play a major role. They lower interest rates, increase money supply. This encourages borrowing, spending, investment. 2. Fiscal policy, government spending. Governments increase spending this includes infrastructure projects, financial aid, tax cuts. The goal is to boost demand and create jobs. 3. Support for businesses. Governments may provide loans, subsidies, tax relief. This helps businesses survive and continue operations. Consumer confidence recovery. As stability returns, people start spending again. Businesses begin hiring. Markets recover. Confidence is a key driver of recovery. Structural reforms. Some countries use recessions as an opportunity to improve policies, strengthen financial systems, diversify their economy. This makes them stronger in the long run. Final thoughts, 1830 to 2000 hours. Recessions are a natural part of the economic cycle. They can be painful, but they are also temporary. Every major economy has faced recessions, and every strong economy has recovered from them. The key is understanding what causes them, how they affect us, and how recovery happens. Because the more we understand the system, the better prepared we are to navigate it. If you found this video helpful, make sure to like for the part 2. Comment your thoughts. And subscribe for more deep insights on finance and economics. Thanks for watching.